Welcome back! This week, I'll share with you career tips for junior research analysts. I want to thank my Instagram followers for contributing to some of the great tips here. For this video, let's assume the interaction is between you and your portfolio manager, but it equally applies if you work for multiple PMs or for the senior analyst or the sector head of your fund. Let's get into it. The 4 big ideas every junior buy-side research analyst should know. Right mindset, non-stop learning, develop your process, people skills matter. I will structure my talking points around these 4 areas. Unless you have been analyzing stocks since you were 10 years old and can become an idea generator right away, most of you don't add much value when you start on the buy side. For investment bankers and equity research folks, good for you with all the modeling skills. Sadly, it's the reasoning and the industry knowledge that go into the assumptions that make the fund money, not the mechanics of modeling themselves. So in the beginning, you're just paid to learn. In exchange, you do the grunt work that your PM does not want to do. So do not obsess over compensation in the first couple of years in this profession, as long as it is not ridiculously insulting. Instead, focus on becoming a more valuable member in all the ways possible. A very close Instagram follower who is a hedge fund partner told me all the candidates he interviewed asked him, what's the upside for me? He had to remind them, yo, you're a junior investment banker. So don't act like you deserve to participate in the upside when you won't be significantly contributing to the upside for the first few years on the buy side. If you really start to develop as someone with consistent insight who can autonomously generate stock ideas, stay at your current shop for at least 2 years and go somewhere else if you're not fairly compensated for your value add. One of my mentors taught me the general rule of thumb is 2 years of buy-side experience dramatically improves your optionality. Most recruiters perceive the 2-year mark to be a plausible attrition point on the buy side. Be open-minded. It's highly unlikely that you will find a shop that invests the exact way you personally believe in, because you're not the PM. Every PM has their own biases, and that carries with them when they became the portfolio manager. I want to help you come to terms with that reality now. But remember, everyone who has been in this business for at least a market cycle or 2 has some sort of repeatable process to make money consistently in the market. For me, despite severe differing philosophies, I still learn many tricks that I wouldn't know because they can only be learned by observing my PM. I wasn't receptive to everything they do, but some of the tools did become part of my toolbox today. If I wasn't told by my mentor to be open-minded, I would have missed out on some invaluable knowledge that can only be learned on the job. Don't have an ego. The goal is to make money. If this confirming information for your stock is staring right in your face, admit you're wrong and move on. It doesn't feel great, but if you're wrong, you're wrong. Learn from it. At some places, you might get yelled at, or worse, your PM will be passive-aggressive. I'm sorry that's the hand you were dealt, but learn to develop a thick face, get back to improving your process, and don't make the same mistake again. And be honest about not knowing. Investing requires high level of intellectual honesty. This is not a fake it till you make it profession. The only person you're fooling is yourself, because the market will eventually tell you that you're wrong. If you don't know something, say I don't know and let me dig into it and get back to you. If you cannot find information that supports your thesis, be ready to concede the stock is just not actionable at this point. Try to stay unemotional. This is obviously easier said than done. Don't get too high on the wins and too low on the losses. You know you have found a good PM if they come into the office every day with the same emotion despite the book being up or down that day. You should strive to develop the same emotional fortitude. If you want to succeed in this business, you must love learning. You just never know what new piece of information you learn today can be that knowledge that helps you develop a variant view on a situation that turns out to be correct. So always be learning and understanding the world just a little bit better. One of the best ways to learn is to be a voracious reader of books. Legendary investors and billionaire business founders are all big-time readers. You get the pattern of success here. Once you have gone through the classic investment books, it's really about reading broadly in different disciplines like history, philosophy, biography of people and business, and so on. I have curated a reading list for all of you for that exact purpose, and you can check them out in the video description down below. The availability of information in the public market is both a blessing and a curse. The blessing is information is easy to find if you want to invest in public companies. The curse is now there is no excuse for you not to be looking at another company or another industry in your free time. Go deep dive on things without anyone asking you to, because eventually as a senior analyst, you are expected and incented to bring your own investment ideas to the table. You might as well start as soon as possible if you commit to a long-term career in investing. Curate your own source of quality information. For me, I read Ben Thompson's newsletter. Not an ad, he's just awesome. I follow a few Substack blogs that cover the industry I follow, and I consistently listen to a few podcasts. Some of my favorites are shown on this screen right now. And finally, I follow investors on Twitter. Once you start doing calls with sell-side research analysts, you start to understand their unique value add for your future purpose. Your network of like-minded buy-side investors will tell you their trusted source of information as well. I will talk a lot more about building a network in the people skills section toward the end of the video, so stay tuned. As a junior analyst on the buy side, you have access to people who have done this job much longer than you have. So take advantage of that. On a Friday after market close, go ask your PM how they size positions, how they develop their idea filters, how they decide on net exposure. If they want to invest in you, they should be willing to divulge that information. Regardless of your investment style, most research analysts on the buy side need to be good at two things: assessing what a business is worth and how the stocks move. How much time you spend on these two things depends on what kind of shop you work at. Stocks are tied to companies. Companies have a history and a story. Their stocks have a separate history and story. And the value of the company does not fluctuate nearly as much as the stock price of that particular company. And value investors believe investment opportunity arises when the stock price over or undershoots the value of the business itself. Those who like to watch movies like I do you like to predict the ending of a new movie? But if you do, how are you able to predict that? It is based on all the movies you have watched in the past, right? Stock investing is similar. It is pattern recognition. The challenge is every stock and company is just a little bit different from the ones you have looked at before. And investment journaling is a great way to develop and improve pattern recognition. You should journal your analysis and decision points. Note down your decision at the time when you bought the stock. As time goes on, keep adding data points to that journal. What were the events that materially moved the stock? Was your thesis at the time of entry right or wrong? If the stock went up, is it because your thesis was right or because something else happened that lifted all boats? If the stock tanked, was it because your thesis was wrong or because something else happened that sank all boats in the sector? In this brutal profession where most judge you on the outcome, you have to stay intellectually honest about whether you got lucky or you made a good decision. And you have to rely on a robust process because luck won't always be there throughout your career. Along with journaling, it is good to establish and refine your investment process. I did not value the need for a structured research process until I was forced into a high idea velocity work environment. To survive, I had to quickly crystallize what key points to hit on so I can cope with the expectation of looking at one company per day in completely unrelated industries. Now, next time when you look at a stock, think about all the steps you take to reach a conclusion and write them down into a document. A repeatable research process is a huge time saver. Follow that process for the next company you look at. Over time, you will learn from investment mistakes and adjust your research process to better address your intellectual blind spots. For example, maybe you used to not care about management compensation, but you got burned by a company that paid excessive compensation for empire building type M&As. So you learn to pay attention to proxy statements for future stocks. In this case, journaling and a research process can both help you constantly improve as an investor. Just because you have no idea generation responsibility as a junior person doesn't mean you shouldn't work toward generating ideas. There are infinite ways to generate stock ideas. All of them are difficult and time consuming because idea generation is not a quantitative process. Even if you quantitatively screen for either valuation or business metrics, you have to dig into each situation to understand what's the history, what's the issue now, and why your view of the future differs from what the market is pricing in. Start developing your own idea generation process today. It can be reading Wall Street Journal every day and reading Barron's over the weekend, or following Value Investor Club or some zero write-ups, reading quarterly letters of funds you respect. It's okay to borrow ideas, but you cannot borrow their convictions. So you need to do the work on the name. If the thesis resonate with your investment style. If you're not comfortable with a particular borrowed idea, that's fine. It's a pass, and you learn about another business and situation. If you gain the same level of conviction by doing all the work, put together a full pitch and float it in front of your PM. I don't think any PM is opposed to hearing a new idea. And you get to practice presenting an idea concisely and defending your thesis, all for the purpose of ramping yourself to an idea generating analyst in the future. Journaling also helps here because it helps you build a bullpen of ideas that you want to own at the right price. Because so often in this business, stocks were not actionable at the time when you first did the work. And that's okay because you can revisit them when the stock price does become attractive. And you can refer to your journal on the information you have found last time. It's a style thing, but I always write down what I want to say when I'm presenting a stock pitch or preparing for a call with company management. Being more prepared just calms me down. For pitches, it helps convincing your PM to act on your recommendation. For meeting with management, you can get more out of management if you ask better questions. I'm not saying you will get material, non-public information, but if you ask good questions, management will give you good answers instead of regurgitating a line you can find in the transcript. Good preparation is also a form of respect of management's time, which makes them like you and again helps you get better information. Don't ask a question that you can find the answer in already publicized disclosures. Before a management call, you can run through your questions with your PM just to make sure. Organize the questions into categories such as growth, margin, strategy, capital allocation, moat, etc. and prioritize the ones that you must get to the bottom of on that call. Learn to kill ideas. Time is the most precious commodity for an investor because there is opportunity cost of looking at something that is not actionable at the time. In a higher idea velocity shop, your PM probably has no shortage of ideas for you to look at. You can make yourself look really good if you learn to kill ideas very quickly. If you reach conclusion that the stock is not actionable based on your research on the 2-3 things that matter to the stock, go ahead and tell your PM. I think he or she will appreciate your judgment. It really pays to stay organized in the research profession, which is something I acutely focus on as a content creator and as an investor. Everyone does it just a little bit differently, and I don't advocate for additional paid tools if a simple one will do. I just use Microsoft OneNote. Some use Evernote. For example, for your investment journal, you can organize it by ticker and then have sections like earnings summary, earnings preview, guidance change, big news that moved the stock, intra-quarter management commentary, and so on. You will have coverage responsibilities on a group of stocks. Be on top of news flows and always have a view on whether that piece of information is material to the stock thesis. Keep digging deeper into the names that you cover to avoid intellectual blind spots. And you should never drop the balls on the largest positions under your coverage. Not a single PM likes drawdown, and the stock moving against you is the market telling you that you might be wrong. Sell side is most helpful for understanding near-term stock movements, but I understand most of us don't have the timely access as a junior, especially at a smaller fund. So you can do something like go on Twitter and use the $ feature to see if you can understand what's driving the move, because your PM will ask. A lot of times a stock move is just noise, and that's what it is. But sometimes you can uncover a reason that could be a good chance to either exit the stock or tactically add to the position. I know you must be thinking the investing legends like Warren Buffett tells everyone not to pay attention to the stock price every day. Well, in reality, we all work with constraints, and 99% of us don't work at Berkshire with that kind of permanent capital and long-termism. So for most of us, we do live the stock market day to day and try our best to understand how the stocks for our companies move. Just because the investing profession is more individualistic than other professions doesn't mean you don't need people skills at all. As a junior research analyst, you don't bring much insight as an investor yet, but at the very least, you are in control of being a good person. It can't hurt to be liked during the bonus season or when you need to rely on external parties to land a new seat. One part of it is just being a good communicator. You want to always think about how to deliver the same message with less words. A good investor thinks clearly, understands what matters, and delivers the message concisely. PMs are very busy, so they appreciate someone who can get to the point up front. Here are the 2-3 things you need to know. Here's how much we are expected to make on this idea. Let your PM ask questions about the details. Your PM is your customer, so start by knowing your customer. Write down their expectations and deliver the products in the formatting they like. Pay attention to their idea buckets when they discuss why they own the current positions in their portfolio. Understand the thesis behind them so you have a sense of what setups your PM likes so that you know what ideas to generate in the future. It's a really small industry. By the time you get to the third level connection, you probably know 95% of all the equity investors out there. Buy-side jobs are mostly filled through referrals. So you want to build a brand so that your next job shouldn't be through a recruiter. I have never gotten a job by applying through career portals, so I understand how job sourcing works in the buy-side land. And go build connections with like-minded investors. You guys can grow together and cover each other's intellectual blind spots. So next time you go to a sell-side conference or a company's analyst day, grab a drink, introduce yourself, ask for contact information, and keep in touch over email, LinkedIn, or Bloomberg IB. That said, I disagree with the advice that you should go build relationship with investors with very differing styles, especially if your style is on one extreme of the spectrum, like I do. For example, you're a long-only investor and you're at a dinner table full of pod shop analysts. I highly doubt there's any common language. How many long-only investors do you know who care about quarterly setups or the buy-side whisper? When you go to industry conferences, you will interface with customers or channel partners who do business with the company you're researching. Make friends with them and ask them good questions so that you can establish a circle of trusted industry experts who can help you understand changes and trends that go on in that industry. Also, make friends with the non-investment people at your shop, the CFO, COO, head of investor relations, etc. If you want to be transactional about it, these people are connected in the industry as well, so you never know when they might be able to help you down the road. But even without thinking about the professional benefits, you can learn about what they do, what are their pain points on a job. That knowledge can help you down the road if you decide to start your own fund. So if the CFO asks you to do a pivot table or formatting a spreadsheet, say yes, because it's an opportunity to build some goodwill, and it doesn't cost you a lot of time as you are likely much more efficient on that task than they do. Find mentors. There's only a small amount of people in this business who are a great investor, great manager, and a good person. Find them, impress them, and become their mentees. I still have monthly check-ins with a few of my mentors, and I'm very grateful for the access and the constant book recommendations, of course. If you outgrow your mentor, find new ones. That is a good situation to be in, but continue to seek out mentorship from someone who is just a little bit ahead of you in the career ladder. Don't be an ass. To sell-siders who made to the buy side, you should know that better than most what it's like to be serving the buy-side clients. Now that you have become the client, you should remember to treat your counterparty with respect. That means be nice to your equity salespeople. Be nice to your rep at the expert network who sources speakers for you. Be respectful when speaking with sell-side analysts or associates. If you work at a smaller fund, know that you are not a top priority to them. So send all your questions at once instead of pestering your salespeople with one question every 15 minutes. Whatever makes their job easier of serving you. Be very consistent with your brand. This is an incredibly small industry. Jamie Dimon said it really well in one of my favorite graduation speeches.
There is already a book on you. That book is already being written. And if I spoke to your teachers, your friends, your professionals, your parents, I would know whether you're trusted, how hard you work, whether you're ethical. I would know so much about you, you'd be shocked. I don't even have to meet you.
People can validate very easily with a phone call. And I'm not just talking about calling your colleagues at the fund they used to work at. Remember, sell-side research, expert networks, and alternative data providers all work with most buy-side firms. I remember doing an informational with a PM at a long-only, And I told him I interned at this hedge fund during MBA. He asked, "Oh, so you know the founder of this hedge fund?" I said, "Yeah." I'm sure he called the founder, and I assumed the founder said good things about me because I advanced to the final round. Once you have grown your connections across all these counterparties, be value to them as well. If you hear something interesting from your research, share it with your peers, with the sell-side analysts, with company IR and management. The entire investment ecosystem is just an information chamber, and helping others reducing information asymmetry always builds goodwill in this business, as long as you ensure compliance. And don't forget, there is a life outside of work. Have hobbies and make friends with people outside the investing industry. Take care of your body, exercise, meditate, eat healthy food, drink water, and get adequate sleep. It builds longevity. What are the tips that have helped you a lot as a junior investor? Please comment below so that we all become better investors. I'd love to hear from you. If you like this video, please hit like, subscribe, and the bell icon for future contents. I'll talk to you next week. Thanks for watching. Peace.